the unemployment rate ticking up for a fourth straight month to 4.6%. Joining me now, Mohamed El-Erian, Allianz Chief Economic Advisor. And Mohamed, listen, I'm having a little bit of trouble with this jobs report. I don't know about you, just in terms of getting that clear picture of what is really going on.
So we should really look through this report.
Okay.
There are so many distortions, and I think Chair Powell was absolutely right when he said we shouldn't take anything out of it. But if you put a gun to my head and say, ignore all the distortions, you have to come up with a conclusion, and I say, do I really have to? And you say, yes, I will tell you it just points to a weakening labor market.
And the weakening, not just we talked to an economist earlier who said most of it has to do with the government stuff. If you take that out, it looks okay. I mean, is that, how valid do you think that assessment is?
So it is valid that a lot of it has to do with the governing government. We lost over 100,000 jobs there. However, if you look at the private sector, you see it's all about health and education. The other sectors are struggling. And if you extrapolate what's happening to the unemployment rate, you would worry. But I want to stress again, these data could be really distorted, and we have to be careful how we interpret them.
Okay, so let's leave the jobs report aside for a moment then. We get other jobs data to some extent, right? We get various private surveys, we get the weekly jobless claims. So if we pretend this didn't happen this morning, and I said to you, what's the character of the job market right now, what would you say?
I would say weak, and most importantly, Julie, decoupling from GDP growth. So we are likely to see continued solid GDP growth and a weakening labor market. That is a relatively new phenomenon, and it's one that puts the Fed in a difficult position, especially given that the inflation rate is stuck around 3%. So we will look good in terms of GDP growth. We will look weaker in terms of the labor market, and we've got to keep an eye on whether inflation expectations remain anchored, which I think they will, but that is key.
Why is that happening? The weakening labor market paired with expanding GDP?
Part of it has to do with the role of AI. AI-related spending has become a major driver. It doesn't have the same multiplier effect through the economy as other spending does. Part of it has to do with the lower end of the household sector. The low-income consumers are having more difficulty. And I think looking forward, people are worried that as AI goes from being a demand issue to a supply issue, that decoupling may increase. It doesn't need to. I want to stress, it doesn't need to. If you talk to companies like Accenture, if you talk to a company like Walmart, they emphasize the labor enhancement side of AI. However, the tendency for a lot of companies will be the labor displacement side of AI.
Well, and how many companies, whenever you see these kinds of technological advancements, you also see them being used as an excuse or reason to slim down, even if it's not actually being replaced by that technology. How much of that is already happening, and how much of that do you think we will see, and how do you tell the difference, I guess?
It hasn't yet happened, and it's a risk. We've been in what people have called a low hire, low fire environment. If you're in a low hire, low fire environment, you think twice about getting rid of your labor force. If we suddenly see a spike in private layoffs, then other companies will use that as air cover. We haven't seen it yet. I want to stress we haven't seen it yet, but that is a risk.
Going into next year, I've heard some optimism around the sort of tax stimulus that's going to be coming into the economy, both for consumers and for companies. How much do you think that will be a tailwind for 2026?
It certainly will be. We will have loose fiscal and monetary policy. We will have continued AI spending. We will have, as a result, solid growth above 2%, which compared to Europe will look incredible. But that central scenario, as compelling as it is, I don't think commands more than a 50% probability. You have two tails that are equally fat. One is a boom, literally a non-inflationary boom, as AI impacts the supply side and productivity goes up. And the other one is a stagflation if the bond market decides to refuse to fund as easily as it's funded so far all the demands from both the public and the private sector, and if there's a policy mistake. So it's going to be an interesting year because while there is a central scenario, it doesn't command an overwhelming probability.
Okay, I want to take each of those things and dig into them a little bit. Okay, so let's take the AI-fueled productivity first. it doesn't feel like we're there yet. And so I wonder, do you think that does start to really take hold in 2026? Is it the later part of 2026? And sort of what does that look like? How do we see that unfolding?
I do see it taking hold. So right now we're obsessed with those working on AI. Gemini 3, how wonderful it is. Oh no, wait, OpenAI is going to come up with something.
Yeah.
It's all about those working on AI. We haven't focused enough on those working with AI, the adoption issue. We don't have an adoption policy. It's not hard actually to put in place an adoption policy. If you freeze those working on AI where they are, and you simply implement throughout the economy what they have achieved, you have a major productivity growth. That is only in AI. What about robotics? That is coming down the pike in an important way. So I certainly think that we will see it play out over a number of years. There is a possibility, not a probability, a possibility that it could be accelerated, but that requires corporate America to really increase their adoption rate.
Are you using it? And which model are you using? Do you have a favorite one?
So I use it all the time.
Okay.
I use Gemini. I think it's incredible what it does.
Like, what do you use it for? I'm just curious. I mean, I use it when I'm doing research for interviews, for example. I've been using Gemini also. So how do you use it?
So I use it for that.
Yeah.
I use it for checking what I write. I use it for looking at slides I use when I teach and ask a simple question, how do I make this more engaging? I use it for a whole range of things, and it has really increased my productivity. It also increases the time I spend on it because I get very intrigued by certain things, but it's incredibly powerful. I generate images, and you'll see, if you look at my weekly, you'll see the image generated. Underneath I put generated by AI.
Right.
And I simply say, when I read a long report, just to make sure I don't miss anything, I say, summarize the main points. So I use it all the time, and I find Gemini 3.0 incredibly powerful.
Yeah, like I say, I've been using that one too. So that's the one side of it. Let's talk a little bit more about Treasury supply, the bond market, because we've already seen little glimmers of that, right? At a time when the Fed is cutting, very unusually, 10-year and 30-year yields are going up. So is that a sign of things to come next year, that we could see more of that phenomenon in the bond market, especially with more Treasury supply coming to market?
So there's tremendous supply from the public sector and from the private sector. Data centers now alone are going at a rate of 150 to 175 billion a year in terms of debt issuance. That is big. Then you have a 6% of GDP deficit. That's big for this part of the cycle. What I worry about is at some stage the bond market is going to say, you know what, we're not pricing in risk the way we should be pricing in risk. That is part of the downside scenario we talked about, is that the bond market's appetite, which has been incredibly strong, somehow becomes less so.
And where do you put that probability?
So I have, and that's not going to satisfy you, I have a 50% probability for the central scenario and about 25% for each side. Okay. And the big message of this, whether you're a policymaker, whether you are a market participant, whether you are a CEO, don't fall in love with your central scenario. Just recognize that it's a multimodal distribution, and you've got to pay attention to the tails. And you've got to ask yourself, which tail can I navigate better?
Yeah, I mean, that's a good lesson over the past few years. Don't get too wedded to that central scenario. Speaking of central scenarios and how things shift over time, we've got new betting odds on who's going to be the next Fed chair, right? That Kevin Warsh has really gained in the odds-making market here. You and I have talked before about who the next leader could be. Kevin Warsh, a good choice? Better than Kevin Hassett? What do you think?
So Kevin has gone from below 10%. Today I looked on Polymarket just before I came in. He was at 47.
Warsh, that is.
Sorry,
yes.
Warsh.
Yes.
And Kevin Hassett is down to 41. So that's a complete transformation.
Yeah.
Now there's some circularity in this because it moved on President Trump's statements, and of course it then attracted people to bet. Look, I have a better view of what Kevin Warsh would do as Fed chair than I do of Kevin Hassett. Why? Because Kevin Warsh has gone beyond the interest rate issue. He has written about balance sheets. He has written about reforms to the Fed. He understands that a Fed that has got its analysis wrong, its predictions wrong, a Fed that has governance issue needs reform. So I'm comfortable with what he favors in terms of Fed reforms. And we know much more actually about what he would look like as a chair than we know what Kevin Hass is going to look like as a chair.
As an aside, how nuts is it that we're talking about the betting markets and who they think the next Fed chair is going to be? Do you think that whole phenomenon, is that useful for markets? Is it useful for society?
It's not useful for this. I mean, it's totally nuts for
it's
this.
Fun. It's fun to talk about.
Because it's the decision of a single person. It's very different from when you're trying to predict millions of people voting. That's very, very different. But having said that, it's the delta that's interesting, because the delta has moved on comments from President Trump.
Yeah, the one person who's making that decision.
Correct.
Mohamed, thanks so much for coming in. It's good to see you.
Thanks for having me.
Appreciate it.
Welcome to Yahoo Finance Invest. The global economy is rapidly evolving from shifting monetary policy to inflation pressures and structural changes thanks to technology. In the backdrop, record-setting markets that are sparking fears of a correction, or even worse. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor. Mohamed, a real treat to have you here at Invest. Thank you for always making time for us. Let's start out of the block here on cockroaches. There's a lot of talk on Wall Street right now on cockroaches, and this essentially is risks coming out of various places, and it's hard to stop them. What say you? Where's the next, economic cockroach to be found?
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war, but the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued. But we're not seeing it, I guess this goes to your point, we're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective.
So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohammed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The one big beautiful bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. How do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived, and the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohammed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate end game for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two Fed officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The five contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done. And I think that all five realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the five candidates, Mohamed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Reeder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, like, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You can see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohamed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's three elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohamed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. You know, for a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Always a treat to get some time with you. I always enjoy our conversations. Mohamed El-Erian, Allianz Chief Economic Advisor. We'll talk to you soon. Thanks for joining us here at Invest. We appreciate it.
Thank you.
The latest dot plot highlighting the growing division among FOMC members, with one member seeing the Fed hiking rates this year, another, who we can probably guess, seeing cuts of 1.25% over the next two meetings. Joining me now, Mohamed El-Erian, Queens College, Cambridge president. It's so good to have you here with us in the studio, Mohamed. And so I noticed you retweet a comment from Jim Bianco, another longtime Fed watcher and investor. And he basically said this meeting was a mess of this latest FOMC meeting in terms of the dispersion, not just of Fed rate cut forecasts, but of the economic forecasts as well. Was it a mess?
And others have called it confusing. So there were two things. On the surface, we got exactly what we expected. We got a 25 basis points cut. We got a signal of 2 more cuts later this year. But once you go beyond that, it's really confused. The economic projections suggest something else: higher inflation, higher growth, and that is not consistent with cuts. In fact, according to the projections, we're going to have 7 straight years where the Fed has missed its inflation target. Then go to what you just talked about, the interest rate picture. If you look over time, it's a dispersion, meaning the difference between the people up here and the people down here is so large that there's no forward guidance. So yes, we got a nice outcome with only one person dissenting, but if you go beyond that, as Jim rightly said, it's a mess.
So, but all of that said, do you think they arrived at the right conclusion for the action that they did, which was the 1/4 point cut?
I absolutely do. In fact, I think a 1/4 point cut was warranted in July. So I'm glad that they're starting the cutting cycle. I'm also glad that they are putting the emphasis on the employment side of the mandate. They are facing this very difficult situation, as we heard Gary say, where the economy is going away from them, both on the inflation side and the employment side. So they are deep in the world of second best, and they have to decide which of the risk is larger, and I think the employment risk is larger. So I like what they've produced. I just hate the fact that we don't get clarity and we don't get an anchor from the central bank. We need some anchor in this economy, because otherwise it's going to get really complicated going forward.
What does that anchor need to look like? What is when you say anchor, what do you mean exactly, and what should they be changing?
So in the past, the central bank has always given us a vision of the future, where things were going. This central bank, after its big policy mistake in 2021, where it called inflation transitory, and as I said, we're going to end up at a minimum with 7 years above target, has become highly data dependent. So it's looking backwards. And as it looks backward, it doesn't give guidance to the marketplace, to businesses. And the problem with not having guidance from a central policymaker is that uncertainty goes up. And uncertainty discourages business from investing and could also discourage households from spending.
In their defense, isn't it a really difficult time to give that guidance? I mean, you know, you're in the economics profession. I've talked to so many economists over the past couple of years who have a new sort of source of humility because it's been very, very challenging to forecast what the economy is going to do. That said, of course, the Fed's supposed to be the best at this, right? They're supposed to know. So, but how can they possibly be forecasting in this kind of environment?
So we need them and others to have a transparent discussion on two things that really matter for all of us. One is, what should we expect for productivity? Will AI, life sciences, robotics, where we're seeing incredible innovation, will we get the diffusion through the economy that allows a significant increase in productivity? I believe so, okay, but we need to hear. And then the second thing, you heard that, the first thing wasn't even mentioned. Yes. The second thing, and we heard that in the press conference, is what's really happening in the labor market? Is it a supply issue or is it a demand issue?
Or both.
Or both. And how much of it is both? And how much it would last? That's really important. Chair Powell started saying it's this and then said, well, no, it's a bit of this. They need clarity on this. And I think that clarity is possible on this. But again, they're shying away. Now, I understand on the enormous political attack. I understand that Chair Powell is coming to the end of his term. But if you don't have a policy anchor to this economy, the risk of volatility goes up, economic volatility, not market volatility. The market is happy to bet on the corporate side. The market is this very strange world where it says, I know the sovereign is messy. We have tariffs, we have central bank independence, we have high fiscal deficits, high debt. I know that's messy, but I'm happy to bet on the corporate side.
But is the Fed the real source of volatility on the corporate side, or is fiscal really, our tariffs, our policies that, sort of are very volatile themselves? Is that the real source of volatility for corporations?
So that's why we need the Fed even more, because on the administration side, they are attempting a major rewiring of the domestic economy and a major rewiring of the global economy. You need some anchor. I remember, I'm old enough to remember the early 80s when President Reagan came in and he undertook a major rewiring of the domestic economy. The Fed was there providing a very clear anchor as to where it was going. And you cannot have a situation where you have major uncertainty on the two greatest influences on the economy.
Now, you, a couple of months ago, made some waves by suggesting that Jay Powell should step down already.
On your show.
As head of the central bank. Exactly. We talked about it. You faced a lot of skepticism on that from various quarters. And now you're saying, even if he doesn't step down, there are certain changes he should be making now to put the Fed on better footing going into the leadership change. What changes should he be making?
So let's start with our discussion of July. At the time, I was worried that because of the tensions between the president and the chair, if Chair Powell didn't step down, the attacks on the Fed would multiply. And that is exactly what happened. And it is continuing to happen. And the reason why is very simple. The administration is looking for cause, a reason to fire Chair Powell. When you look at an institution, take a microscope to it, you will find something. And they are finding one thing after the other. And in the process, the objective of the administration is changing. Who would have thought in July that they would have their eye on the reappointment of the regional Fed presidents in February? But suddenly that's there. So what I was afraid of is happening. The other thing that's happening is now there's a massive understanding about something you and I have talked about before, is you need fundamental reforms to the Fed. You need greater accountability, you need greater transparency, and you need less groupthink. And we have really good examples of other central banks that have addressed these issues. The Bank of England, for example, has external members on the equivalent of the FOMC. And those external members guard against groupthink. Because if you're within the Fed, the incentive to be in the herd and not question it.
Well, but at the same time, on the one hand, you have this huge dispersion in the dots, which we called sort of a messy meeting. On the other hand, you don't want groupthink. I mean, don't the dots illustrate that there isn't groupthink?
And that's the problem. People are saying, so let me get this right. We have dispersions and where we're going. We have inflation going up. We have growth going up. We have employment, according to the Fed, only peaking at 4.5% and coming back down. And yet we're cutting. You would have expected two-sided dissents. That's what you get at the Bank of England. We didn't. We got one dissent. In fact, one of the big surprises is we only got one dissent.
Right.
And I think it's important to understand what happens in a group dynamic is that you tend to iterate and converge towards a view. And that, unfortunately, undermines the sort of cognitive diversity you need at turning points. There is a reason why the Fed has been consistently late, because they don't have the amount of cognitive diversity that they need to say what if. I thought Stephen Moran was really interesting when he said, I'm not the smartest in the room, but I'm willing to ask the questions that other people aren't willing to ask. And I think that the Fed needs more of that.
But a voice like Myron, or whoever ends up being the Trump-appointed nominee to replace Powell, how do you separate an earnest intellectual discussion from someone who is effectively a plant of the administration?
So look at the Bank of England. All the external appointees are people that have come either from economics or finance, that have come from outside the government, outside the central bank. It's understood they're going to serve 1 or 2 terms and go back to the outside. So they are technocrats. And then they join other people that have different backgrounds. And that's the whole point of cognitive diversity, is you bring different viewpoints. And it's really important. My career has shown that when you have different viewpoints in the room and you can talk about it in a safe area, you get better outcomes.
All right, well, we'll see if that happens. If there's any chance of that happening, especially before the turnover in the Fed chair. Mohamed, thanks so much for coming in.
Thanks for having me.
Really appreciate it. President Trump reiterated his criticism of the Bureau of Labor Statistics, said he was close to picking a new Fed chair, and teased new tariffs on semiconductors. Joining me now, Mohamed El-Erian, president of Queen's College, Cambridge, to talk about that and many other things. Mohamed, good to see you.
Good morning, Julie.
I would like to start with this whole situation over the Bureau of Labor Statistics, the BLS. With President Trump's removal of the person who heads up that agency, what does that do to confidence in future statistics? We've got, for example, CPI coming next week from that agency.
So I think there are 3 takeaways, Julie. The first one is that the way the head was fired, and she was fired just following data releases that the president liked, that erodes institutional integrity. And institutional integrity is very important in the US economy. The second focus is on the problems we're having collecting and estimating data. These have been long-standing problems that have been getting worse. As you know, the reporting level has come down. As you know, the methodology used for estimating when you don't have the data is breaking down. So there are fundamental issues that have to be addressed. And that includes not incorporating enough new data sources, because we saw during the pandemic that there are all sorts of non-conventional data sources that shed a lot of light. But the third issue, the one that's not talked enough about, is when you tend to have such large revisions, they tend to be at point of economic inflection. They tend to be when things are changing in the underlying economy and the data simply cannot keep up with what's changing. And I think that third element is going to be important as we go forward.
Okay, so let's dig into that third element, because those revisions were alarming, right? And on Friday, it seemed to sort of fundamentally shake the assumptions that a lot of market participants had about the labor market, that it was holding up okay. So A, do we believe those revisions? Do they reflect what's going on? And how concerned are you then about the labor market?
So I think the revisions are consistent with a lot of anecdotal data that comes from talking to households, that comes from looking at companies' earnings. And what you basically get is the following. Pricing power for those who sell to low household incomes is very low, because low income households are suffering. We also have seen other signs of weakness. So I think what the labor revisions have picked up is a weakening economy, not an economy going into recession, but a weakening economy. And ironically, 2 days later, in terms of trading sessions, the bond market has priced in a weaker economy. The pricing of Fed cuts, that probability, as we heard, is up to 90%. So the fixed income side of the markets has understood what the data is telling us. The equity side is being supported
in a fundamental way by two things. One is the notion of FOMO. Every time we've bought a dip recently, in the recent few years, it has been profitable. So people have been conditioned to buy a dip. And second, this distinction between tech and AI and the rest. And tech and AI is enough of a locomotive to drive the whole market up.
I want to talk more about that in a moment, but first I want to dig a little bit more into the labor market figures, because we've talked to some folks who have suggested that if the Fed had had those numbers, they would have cut at the last meeting. Do you think that a cut in September is a lock, and do you think it could even be an outsized cut?
So first, I agree that had they had those figures, they would have cut, and a number of us were urging them to cut based on what we were witnessing from the bottom-up data. But they are very top-down driven, so the top-down data didn't show them that until now. So yes, they would have cut, and they should have cut. Secondly, is it a lock for September? Yes. Is it possible that they do 50 basis points and not just 25? Yes. I mean, remember a year ago, they didn't do anything in July, and then come September, they delivered a jumbo cut of 50 basis points. So I think a 25 basis points cut is a lock. A 50 basis point cut is a possibility, not yet a probability, it's a possibility.
And let's talk a little bit more about the structure of the Fed. You made some waves recently, Mohamed, when you suggested that Jay Powell should just step down now, shouldn't wait till his term is up. And listen, I heard from a lot of folks who did not agree with that assessment. Do you still hold that view? And why do you think that's the right thing?
I do, and like you, I had lots of discussions, and about half of the people I spoke to vehemently disagree, and the other half agree, but don't want to be public about it, because they're worried that this will be interpreted as somehow undermining the Fed. The reason why I said what I said is because I want to protect the integrity of the Fed. Chair Powell is leaving in May for sure. Everybody knows that. He's going to be a lame duck well before this, because we're going to have an announcement about who is going to replace him. The longer he stays there, the more the administration is going to look for cause to dismiss him. The more they look for cause, the more they're going to go into the Fed, and we risk a non-recoverable mistake, which is undermining the integrity of the Fed for a long time. And it's not just the administration. We've seen the Speaker of the House and Congress thinking maybe we should revisit the act. So these attacks are broadening and deepening. Now, is it the first best for him to step down? No, it's not. But the first best is not available. The first best is that he serves out his term and the Fed doesn't get attacked politically. But I suspect we all know that the Fed is going to continue to be attacked as long as he's chair.
Yeah, I think that is likely a safe assumption. I'm not going to continue the should Powell stay or not debate. I want to move on to something that we heard from the president this morning. He was asked about the four contenders that have been talked about to replace Jay Powell at the Fed: Kevin Hassett, Kevin Warsh, Christopher Waller, and Treasury Secretary Scott Bessent. And he sort of dismissed Bessent. He said, no, he doesn't want the job. He's off the list. We're not going to do that. He didn't really address Waller. He said the Kevins would each be a good choice. Do you think a replacement for Powell like Waller, because he is already a Fed insider, would be more helpful to the cause of Fed independence?
I think either Kevin Warsh or Chris Waller would be helpful to Fed independence. They are both experienced. One is serving on the Fed board, the other one served on the Fed board. They're highly respected. So I think, yes, they would be good for Fed independence. What I found interesting is that while he said that the Treasury Secretary is not interested, he said there were four other than Scott
He did.
Bessent.
Who's the other one?
I suspect it's David Malpass. That's the name that has been mentioned the most. David was the president of the World Bank, and before that, he worked at Treasury.
Do you think he would be a good choice?
So I think you have very strong candidates in Kevin Warsh and Chris Waller.
Okay, that's a diplomatic way of saying it. Mohamed, I want to move back to this AI theme, as I promised we would come back to that. I know that you tweeted also about that this morning, the sort of Caterpillar versus Palantir economy, so to speak. what does that tell us about the economy that, that you have this divergence? Is it concerning, in other words, that a lot of the growth engine right now is coming from things related to AI?
No, that's what I would expect would happen. I am incredibly optimistic about the productivity enhancing potential of AI and more generally of innovation in technology, in life sciences, and in robotics. And I tell you, I've never been as optimistic about productivity as I am right now. But it is a sequence. It starts with firms that are either quasi or completely AI native. And what Palantir told you today is that they are monetizing the AI. So those who doubted it could ever be monetized, well, it's being monetized. And we're seeing this not just in Palantir, but in other places. The second challenge that comes after you monetize with the AI natives and quasi-native is diffusion throughout the economy. And that's when you get the huge productivity impact. And what we are learning is that this diffusion process is uneven, that some firms are quick adopters, others are very slow in adopting. So dispersion is not going to just be between tech and non-tech, which is what we're seeing today, but also within non-tech, between those that are quick to understand the incredible potential of AI and those who don't have the initial conditions to do this quickly.
And then when you look at Caterpillar, on the other hand, its business is still sort of plugging along. It did talk about a tariff impact. And I'm curious your current thinking on tariffs. We did have the president also in that conversation saying the tariff on India is going to go up in the next 24 hours. He's sort of trying to punish them for buying Russian oil. He said they're getting close on China. So what does all of this mean for economic growth?
So first on Caterpillar, it's interesting because a few months ago, they simply couldn't tell us what the impact would be. Now they're telling us the impact is about 1.3 to 1.5 billion of additional cost. So that is telling you that they are incurring the cost and they're not able to pass on as much as they would need to keep their profit margin constant. And I suspect that we'll hear this over and over again from most companies, not all, then from most companies. India is really important, Julie, because that's a secondary sanction. The president is threatening tariffs on India because India buys oil from Russia. And secondary tariffs, once you go down that road, the question is going to be, what about China? China also buys a lot of oil from Russia. And we are in the midst of negotiations with China. Will this play in? Will this not play in? Will it be inconsistent with India? These are all questions that are going to have to be sorted out in the next 3 months.
U.S. trading partners are readying a response to President Trump's recent barrage of tariff threats, including a potential 30% levies against the EU and Mexico announced over the weekend. In a piece for the publication Foreign Affairs, Queens College Cambridge President Mohamed El-Erian wrote that the U.S. has, quote, shaken the very foundations of the global order, adding that there is no trusted conductor to guide countries and companies through the complicated transition to whatever's coming next. Joining me now is Mohamed El-Erian. Always a pleasure to talk to you, Mohamed, and thanks for being here, obviously, in what continues to be a very tricky time here. So I guess I would ask first whether you think we are witnessing a sort of remaking of the global order. It seems like there have been so many fits and starts. It's difficult to get that big picture.
So I think that we are no longer in a world of uber globalization, where we're looking for ever closer integration of goods and people and flows. The question is, are we in a world in which there is managed globalization light or total fragmentation? That's the question mark. And we're not going to know this for another few years, I think, Julie.
And I thought the other thing that was very interesting that you wrote in your piece is that the U.S. is almost behaving like a developing nation rather than its sort of global dominant status. What do you mean by that, and what are the implications of that?
So we're seeing market correlations that normally are more common to developing countries than the U.S. For example, the currency weakens even though yields are going up. That shouldn't happen. The negative correlations between bonds and equities has broken down. So you're starting to see things, and you're starting to hear narratives that are more common in developing countries than in the US. And I think that that's partially because the US is trying to remake its domestic system. There's a real question mark as to whether this is a Reagan moment in which the US changes things with a view to a better outcome, or is this a Jimmy Carter moment in which the US ends up in stagflation and ultimately recession?
Which do you think it is, Mohamed? Or if we don't yet know, how will we start to know?
So first, let me tell you, the market is all over the place on this. We started the year with an 80% probability that this was a Reagan moment. By the beginning of April, we were below 50%. And now we're somewhere around 70%. So we have fluctuated a lot. And that is unusual for the US with its mature institutions and big diversified economy. I think it's a 50-50. I don't think we know. I think it will depend on how other countries react as well. So it's a 50-50, but the marketplace right now seems more comfortable than I would be with where we're going.
Well, I wanted to ask you about that because what do you make of the extreme equity resilience here in the US in the face of all of this back and forth?
So I think there's two things going on. One has to do with the view that corporates aren't the sovereign, that you may have issues with the sovereign, but at the end of the day, US corporates are strong, good balance sheets, good innovations. That's one view. The other view is that people ultimately think that the US is escalating to de-escalate. That what we heard over the weekend against the European Union, against Mexico, is negotiation. And come August 1st, one of two things are going to happen. Either we're going to push the deadline out yet again, or the US will get what it wants from its trading partners. So the markets are pretty relaxed about this, more relaxed than I would be, but I understand that is the trade that has worked over and over again. And you don't want to get in the way of something that's been working.
Mohamed, as we and our viewers know, you are a longtime veteran, very well-known investor. What they may not know, you've also served on a number of corporate boards. You're currently on the board of Under Armour. So I'm not going to ask you specifically about those businesses, but I am going to ask you about that experience with these corporations and how they're tackling this current moment and how challenging or not, maybe, they're finding it.
So most CEOs I know will tell you that we are in a wait and see, Julie. We're waiting to see what is going to evolve. And that's important because it impacts your supply chains. It impacts how you think of where your markets are. So whereas the financial markets seem comfortable, what we're seeing on the CEO side is postponement of major investment plans, just waiting to see. It makes a huge difference whether the tariffs are 30% or 10%. It makes a huge difference whether the tariffs are volatile or whether they're going to be fixed. So companies are doing what most people would do is, you know what, I'm not going to commit multi-year investment funding until I know what landscape I'm operating in.
So the markets, of course, about this acronym TACO, right? Trump always chickens out, that the markets seem to have adapted to some extent. But when it comes to being a corporation, you can't really, I guess, bet on that kind of acronym, right? But I mean, do you think the markets ultimately were wrong about TACO, or do we still not know how that's going to play out?
So the markets were right in saying that the deadline will be pushed back and will be pushed back again. That's correct. What we don't know is ultimately what the destination is. So the journey has been consistent with a much longer time frame than what economists were afraid of. But we still don't know what the destination is going to look like. I'm hoping that we are going towards some sort of globalization light that is managed more, that the US feels that it's trading in a fairer trading system, that it no longer is responsible for so many public goods that are really expensive. That's what I'm hoping we're going towards. But we could just as well end up in a fragmented global economy. And for companies, what you're going to hear, for example, under Trump 1.0, we went from this notion that China can be your market, China can be where you have supply chains. Do you need C+1 or C+2? One or two other countries to increase your resilience. Now you hear C plus many, and some companies don't even want the C, they just want the many. And that means rewiring your supply chains. And that's not something that you do quickly. It takes time to do so, and it is expensive.
I'm glad you brought up China, because I know there is some strategists have speculated out there that part of the reason that the market hasn't reacted more to the tariff headlines is because they haven't involved China lately, right? Most of the focus has been elsewhere, and China is the big elephant in the room, so to speak. Do you think there's any truth to that? And what do you think we need to watch for when it comes to China headline risk?
So we know from Mexico, for example, that if you're not in focus today, it doesn't mean you're not going to be in focus tomorrow. I think Mexico was surprised over the weekend to hear about the possibility of a 30% tariff. They thought they had sorted that out. So I don't think China is out of the woods. I don't think anybody is out of the woods right now until we settle this tariff issue. But there's a broader issue with China, which is how quickly will it reform its economy. China right now is no longer a locomotive of global growth. In fact, the concern, and we saw the export numbers today, the concern is that China will start dumping its exports on other markets, especially the European Union, which will cause trade tensions there. So keep China on the radar screen. You cannot ignore it right now.
Mohamed, finally, quickly, since you mentioned the EU, the bloc says it's preparing a response, but it's willing to continue to negotiate. In the meantime, there's some reports that the EU might be looking to other countries to sort of form some alliances. What do you think of that? And do you think that the EU Europe generally, the stock market has been a good investment this year. Do you think that continues as a result of their positioning?
So I think the European financial markets are benefiting from the fact that the whole world was massively overweight the US starting this year. The US had outperformed other countries consistently. The US is where the major drivers of innovations are. And the US has a fiscal policy that's quite loose. So there was reason to invest in the US. During the year, what you've had is a realization that overweight is excessive. And that's why European markets have outperformed US markets so much in the first quarter by 17 percentage points, Julie, 17 percentage points. I think that for the outperformance of Europe to continue, Europe has to get its act together. It's one thing that having capital pushed out of the US back into Europe. What Europe really needs is to be able to pull back, attract the capital back. And it hasn't been doing enough for that as yet.
Very interesting stuff. Mohamed, always a pleasure to talk to you. Thank you so much. We really appreciate it.
Thanks for having me.